Hey, Steve Saretsky here. As always, every Friday, bringing you the Vancouver real estate, Canadian real estate market update video. Just in transition here in Costa Rica, ending off my vacation. So I'm obviously different scenery in a hotel room here. But just wanted to basically put together another quick short video to keep consistent every Friday. So a couple of things that I really wanted to touch on is obviously I did a market recap or a yearly recap a couple weeks back on the Vancouver real estate market as a whole, recapping the numbers for 2017. I just quickly put out a post for the Fraser Valley, which, if you're not from Vancouver area, it's the suburbs of Vancouver. Keeping a sort of a closer eye on that market, obviously do some business there as well. And also want to talk on the rising mortgage interest rates, Bank of Canada announcement next week. First off, the Fraser Valley, it's that typical, as prices get expensive in Vancouver, the greater Vancouver area, people start to spread out. I've seen that previously in other housing booms. It's basically been, quantified. What they call it is a drive to qualify. So people basically begin driving further and further out into these suburbs in order to qualify, in order to basically go after, what they can afford. And that ultimately starts to drive up the prices of, say, a Surrey condo. And as those prices rise, it basically creates a sort of a positive feedback loop that actually attracts more investors and more speculation, which ultimately pushes the prices even higher. And so looking at those numbers for all of 2017, taking the average sales price for the Fraser Valley, which is like Surrey, Langley, Abbotsford, Mission, I think that's it, and White Rock. Basically, these areas are all minimum 30 minutes outside of Vancouver. 45 minutes outside of Vancouver, so obviously a much longer commute. The average sales price for the year increased 25% for condos, and the median sales price increased by 30% on a year-over-year basis. Again, that's taking all of 2017, so it's not necessarily telling you what the market is doing at this exact point. But looking at that growth that we had in 2017 is obviously incredible. Especially when you, again, put it into context that Fraser Valley condos were basically flat for the last 7 or 8 years. There was a lot of inventory. In some areas, realtors actually used to turn down condo listings because they're very difficult to sell. And obviously now everybody wants them because they're selling in a week. And as we see, prices went up 25 to 30%. So that is something that I've watched. There was something like $860 million extra dollars spent on Fraser Valley condos this year. That's the total dollar volume. So again, always looking at this more from like a macro standpoint, a macro view. Looking at that additional $860 million spent on Fraser Valley condos tells you where that money is flowing. It also tells me that, I know that obviously governments are loving that despite what they say. And this is always, they can say one thing and do another. Looking at how governments will bring in policies to affect the market is always that for every action, there's a reaction, right? They're obviously very careful with interfering with the housing market because, as you can see, $860 million extra spent on Fraser Valley condos. Think about all the property transfer tax revenue that's bringing in. It's obviously a substantial amount of money. It's basically what's been driving the BC economy. So I'm looking at those numbers and always, trying to basically get a read on the market and what I think it means for the overall economy. Speaking of the economy, the couple of big banks, RBC and TD, increased their overnight lending rate from 4.99% to 5.14%, so 15 basis points. So people ask, what does that mean exactly? What it basically means is it's a very important rate to follow if, especially with this new mortgage stress test. So as a mortgage stress test, I've explained it in numerous videos, but basically, you might be borrowing a mortgage at, say, 3% or 2.5%, say if it's a variable rate, you might be borrowing at 2.5%. But at the end of the day, you have to get stress tested. You have to get qualified based on borrowing at that overnight minimum at the overnight rate, which was 4.99%, or higher of your borrowing rate. So let's say you're borrowing at 3.5%. you have to add on an additional 2% on that and qualify based on 5.5. So it's whatever is higher, either the overnight rate higher or the stress test or your current borrowing rate plus 2%. So let's just give a very quick example. You're borrowing money at 2.5%. You would then get stress tested at that overnight rate of 4.99%. Again, that's now going to be shifting up, looks like, to 5.14% if you get another one of the big banks on board, which it looks like that will probably happen. That will become the new benchmark rate to get qualified at. So that would be the minimum requirements. And again, that will then reduce typical mortgage by about 1.5%. Again, obviously not much, but as you can see, every little rate increase is going to matter that much more. When you have, and the Bank of Canada right now, just so you guys know, January 17th, the Bank of Canada is making their next interest rate announcement. The market is pricing in an 86% probability that they will hike interest rates by another 25 basis points on January 17th. So the market has basically been pricing that in. You had a Canadian 5-year bond yield increase just over 2%. That Canadian bond yield, that 5-year Canadian bond yield, is almost directly correlated to the 5-year fixed mortgage, which RBC also increased last week. So the bond market and the Bank of Canada, you really have to watch those two guys to get a really good understanding of where interest rates are going, what it means for the market. Obviously people say, well, what's 25 basis points? You have to look at the context of things. Interest rates are at all-time historic lows. The Bank of Canada hiked twice in 2017 from an interest rate of 50 basis points to 1. We're at a full 1%. So you can say, well, it's only 50 basis points, but what you have to look at it as it's actually they've doubled they've doubled the interest rate. So that is substantial when you factor in that Canada's household debt has never ever been this high. It's one of the highest in the advanced economies. You have record high house prices, and you have rock bottom interest rates. So high debt, high house prices, rock bottom interest rates. As those interest rates start to creep up, every single movement is very, very important. And as you can see, particularly so when you even add on a stress test, and the fact that you have to get qualified now based on that overnight lending rate, which has now looked like it's going to jump from 4.99 to 5.14%, and that is in turn going to reduce the typical mortgage by about 1.5%, your typical borrowing power. So yeah, I mean, all these things are something to watch for in 2018. Obviously, we don't really know the full path of interest rates. It certainly looks like a tightening is underway for global central banks. So it's a trend that we'll be watching. I'm still in the bearish camp of interest rates in a more longer historical basis. I think that listening to some very smart people, there's the argument out there that we're not necessarily out of our low interest rate environment. We actually could be seeing new lower lows in the near future, but the current trend, and it looks like the trend for 2018, is a tightening. It is going to be rising interest rates. So we'll wait and see how that all plays out. And that's all I got. If you have any comments about that, any questions, put it in the comment section below and I'll answer that. Other than that, I'll see you next Friday. I'll be back in our regular studios. All right, see you later.